Stock market madness, Ukraine invades Russia, Italy tricks the rich, a revolution in Bangladesh, and Western companies lose confidence in China. These are, in my opinion, the most important economic stories that we need to talk about in this economic update. So let's dive into our first story right away, which is about the stock market crash and rebound. Roughly 2 weeks ago, most stock markets, and especially those focused on tech and Asia, crashed. This obviously led to a lot of commotion, talk about broken stock markets, and fears for a further fall in stock prices, which could eventually cause a recession. It also led to a lot of speculation about what was causing the stock market to fall so fast. Luckily, now that the dust has settled a little bit and stocks have recovered at least some of their losses, that is at the time of recording this video, it is a perfect time now to ask ourselves what happened. Well, scouring the internet for answers, I essentially found 4 main explanations. The first is that it was caused by the release of unexpectedly weak job market figures from the United States, which could signal that a US recession is imminent, which would in turn be really bad for company profits everywhere. Hence stocks going down. The second explanation is that this all started in Japan, where the Bank of Japan raised interest rates to stop the yen from falling. Higher interest rates then caused Japanese stocks to crash because they mean that stocks are suddenly a less attractive investment compared to having your yens in the bank. On top of that, ultra low rates in Japan compared to the rest of the world, especially after COVID, had made it super attractive for people to borrow in Japan and invest it in the rest of the world. This investment strategy of profiting from ultra-low rates in, for example, Japan, by borrowing in yen and investing in Mexico is known as the carry trade, a lucrative strategy as long as rates remained low in Japan and the yen was falling. However, when the Bank of Japan raised interest rates, this strategy suddenly became far less attractive for 2 reasons. First, it made borrowing in Japan much more costly. Second, increased rates caused the yen to go up. As a consequence, yen debt taken out by carry traders suddenly got much bigger compared to their investment in the rest of the world. Ironically, when these carry traders then sold their foreign investments to buy yen to repay their debts, they caused the yen to go up even more, making the carry trade even less attractive, and so forth. A positive feedback loop. Therefore, according to this narrative, a Bank of Japan rate hike not only caused stocks in Japan to go down by a lot, but all over the world as well. The third narrative I found is that the market crash was caused by a dawning realization that while AI technology is promising, it is perhaps not promising enough to justify the billions of dollars invested by American tech companies and semiconductor producers in Asia. This could explain why especially tech and Asian stocks suffered from this particular stock market crash. Finally, the fourth narrative is that stock markets these days are simply more volatile for technical reasons that have nothing to do with the state of the economy. Instead, crises like the 2011 Eurozone crisis, 2013 taper tantrum, and this latest market panic tend to happen in the summer because this is when traders are on vacation, leaving even more trading up to potentially volatile trading algorithms. If this story is true, this latest collapse and partial recovery is likely just another blip in a long list of irrational market panics. So, as is so often the case, there are multiple convincing, well thought out narratives that can explain what we have seen. But which one is correct, or at least most correct? Well, despite newspapers often pretending to know the answer, the sadly complicated reality is that nobody really knows why markets go up and down. That being said, I personally was not convinced by the US job market story because this data was not so bad and because a potential recession might these days often actually be good for stocks because it would encourage the Federal Reserve to lower interest rates faster. So I put my money on this downfall being a consequence of the other 3 stories, plus perhaps a consequence of central banks all over the world reversing their quantitative easing programs and having higher interest rates, a situation that markets just have not been used to yet. If that is true, we should prepare for more volatility. A troubling message, but if we want to put our minds at ease, it is always helpful to zoom out. by, for example, looking at the S&P 500 index over a year, which, as you can see here, still did really well this year despite this panic. Zooming out may also explain why I think that Ukraine's remarkable invasion of Russian territory matters for the global economy. The biggest geopolitical story last week was that Russia invaded Ukraine, and that, in contrast to earlier incursions, Ukraine has now committed its own elite troops and has taken a sizable chunk of Russian territory. In doing so, it likely hoped to draw the Russian forces away from the front line in Ukraine, where Russian troops had been steadily advancing. But okay, why does this matter for the global economy? Well, two reasons. First, Ukraine is not just getting desperate because it is again steadily losing territory, it is also running out of dollars fast. After all, if a lot of those billions of dollars in aid you hear about, they don't come in the form of money, they come in the form of weapons. And given that Russia's invasion made Ukrainian industry far less competitive, the Ukrainian trade deficit has exploded, which means that it is bleeding foreign currency. So much so that the country was estimated to be less than a month away from a default by The Economist. But to convince foreign investors to provide it with much needed relief, the Ukrainians need to at least appear to be either winning or heading towards a stalemate or ceasefire where industry can, start back up. So it could be that Ukraine's worsening financial situation is actually making it so desperate that it now chose to divert troops away from its own territory to Russia. The second reason why I think economists need to track Ukraine's invasion as well is that the Ukrainians recently captured the last operational gas transit point from Russia to Europe via Ukraine. And while this gas route is no longer very important for Europe as a whole, Austria still actually gets a lot of gas through this pipeline and would need to import gas from Italy and Germany to replace it if it stops, putting pressure on energy prices in Austria and the rest of Europe. But while there is currently no indication that the Ukrainians or Russians will stop this flow to Austria, the risk of it happening has just increased, which could explain why European benchmark gas prices jumped as much as 5.7% early August. So keep an eye on European and in particular Austrian gas prices and a potential Ukrainian financial default or bailout by its allies in the near future. Another interesting story that I have been keeping an eye out on lately is that Italy seemed to have tricked the rich, who on the run from higher taxes in Britain and potentially Switzerland were increasingly moving to Milan after promises of a juicy tax incentive in which no matter your income you'd only need to pay the Italian state 100,000 euros every year. A tax structure that is not very attractive to most, but if you have a high six-figure income, 100k in taxes is potentially a great deal. However, after a popular backlash, Italy's Prime Minister Meloni recently announced this tax would double to 200,000 euros per year, making Italy much less attractive for many millionaires all of a sudden. This is relevant for the global economy because it is part of a larger trend where, while small countries like the UAE, Singapore and Greece increasingly try to attract the global wealthy, traditional tax havens like Britain and Switzerland are becoming less attractive. So, what can we expect from millionaire migration in the near future? Recent research projections by Henley and Partners seem to indicate that millionaire migration is driven by three main factors: economic opportunities, personal safety, plus convenience, and the tax burden. So countries that have all of these, like Singapore and the UAE, are increasingly attracting millionaires. At the same time, countries that are not necessarily tax havens, but still great places to live with a lot of opportunities like the US and Australia, also still attract a lot of millionaires and billionaires. On the flip side, the most millionaires are projected to flee China, which is perceived as less safe for millionaires at least. Right after that, Britain follows, after its clear intention to scrap the long-standing so-called nom-dom tax incentive, which allowed wealthy UK-based foreigners to consider themselves domiciled overseas to avoid paying high taxes in the UK on overseas income and wealth. But while Italy's increased flat tax only applies to the rich people moving there after the law goes into effect, I think the move to double the flat tax shows that countries face a really difficult balancing act, both economically and ethically. On the one hand, governments want to maximize tax revenue to maintain investments or the welfare state. Giving millionaires a tax break can increase overall taxes collected if you attract enough of them. But if other countries respond with their own tax breaks, it could lead to a race to the bottom. On top of that, most voters find it deeply unfair, of course, that the richest in society get the most tax breaks, meaning that the more millionaires you attract via tax breaks, the bigger the political backlash that you can expect. A tricky balancing act, as Britain's case demonstrates, that removing these tax incentives can quickly lead to a millionaire exodus. A government that has bigger problems on its mind, though, is Bangladesh, which just went through a revolution, where Prime Minister Sheikh Hasina recently resigned and fled the country following weeks of student protests about a quota system that reserved 30% of government jobs to loyalists. A big deal in an economy that relies heavily on the state to keep it going. After violent repression by state forces had failed to quash this unrest, the army refused to kill more students, causing the Prime Minister to flee. After this, the army invited a Nobel Prize-winning so-called banker to the poor, Dr. Mohammed Yunus, to head the Bangladesh army-backed interim government. The revolution in Bangladesh is crucial for the global economy for two reasons. The first is simply that Bangladesh has a lot of potential, given that it is the 8th most populous country in the world and was until recently considered a massive economic success story, as the country was lifted from absolute poverty in just a few years. The second reason is that Bangladesh plays a crucial geopolitical role, being completely surrounded by India, while importing mostly from China and exporting mostly to the West. So what does this revolution mean for Bangladesh's economy? Well, I went looking around and found that The Economist argues that the fact that the military refused to kill more students and then invited Dr. Yunus, is a really hopeful sign that this is a genuine chance for Bangladesh to become a more open society. That is, if Dr. Yunus takes the time to reform Bangladesh's dysfunctional government institutions, which is quite difficult. In this scenario, Bangladesh might continue to grow to become the next Asian growth miracle. However, slow and difficult reforms, will always be really difficult, and especially given that Bangladesh's main opposition party, the BNP, does not have a great track record and has weak leadership right now, leaving a lot of political space for radical Islamist parties to rise. This is an outcome that India tried to prevent by supporting Sheikh Hasina to the bitter end. But that support has of course made a lot of Bangladeshis really mistrust India. But mistrust or not, Bangladesh's dependence on India, China and the West simply mean that it could easily become a victim of a great power struggle. Is that really an environment in which Dr. Yunus can reform Bangladesh's government? Or will the country plunge into anarchy? We will have to see. But to the north, one thing is for sure, and that is multinationals are struggling in China. Specifically, the Financial Times reports that the CEOs of companies ranging from L'Oréal to AB InBev report falling sales growth, while car maker CEOs like those of Porsche and Mercedes-Benz even report falling sales. This is the reversal of one of the big trends dominating the global economy in the past decades, which was, Western companies, if you want to make a lot of money, move your production and sales teams to China. Most Western CEOs now blame the slowdown on a weak Chinese consumer demand. But let's be honest, that would mean that they are not to blame. A pretty convenient excuse. So are they right? Well, on the one hand, their fears about reduced demand are in line with most reporting on China, which indicates that house prices continue to drop. This continued drop in household wealth could then explain why analysts from, for example, Fitch report that Chinese consumers are moving away from premium and luxury goods and back to cheaper goods. On the other hand, I already reported on this channel over a year ago that German car makers had simply acted far too late as their Chinese competitors rapidly switched to electric engines. So while China's consumer slowdown is real, Western companies are also genuinely outcompeted in many booming sectors like electric vehicles and other solar panels. Booming sectors like solar and cars, and at the same time very weak consumer demand, this may seem like a contradiction to anyone who has not seen my video about China's failing growth miracle. A video that you can now watch without any ads to interrupt your viewing pleasure on the creator-owned streaming service Nebula, where you should follow me to stay up to date about almost all of the latest news. And indeed, as you may have noticed, I said almost all of the latest news because, as a small creator, I might occasionally miss some big events in the global economy, which is why I'm very happy to announce that I have joined a team of creators like Wendover Real Life Lore and TLDR on Nebula's brand new news page, which ensures that you can easily stay up to date about the latest global developments. After all, if you want to know what's going on in the world right now, on YouTube you either have to visit all of these channels manually or just have to trust that the YouTube algorithm will always just show you the most appropriate video, which, it often doesn't. However, if you now log into Nebula and go to the news section, you will find videos on a page that has been handcrafted to reflect only the latest, most important news. The Nebula news page also allows you to get multiple quality videos about the same subject, like, for example, the Chinese slowdown. What's even more exciting is that Nebula News has an exclusive show that is very similar to this show, my economic update, but then about geopolitics. This show is called The War Room and is produced by Real Life Lore, and it summarizes all of the most important updates about actual wars that have happened in the last month. So, if you are interested in staying up to date in a more convenient way that also happens to be ad-free, and importantly, support me directly as a creator, then consider signing up to Nebula using my link at nebula.tv/moneymacro or the link in the description for a 40% off a yearly Nebula subscription.